Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a concept which is outstanding shares. We're going to learn the definition, formula in the same. Let's see the graph over here. If you see the Amazon's diluted shares outstanding and Amazon's basic shares, which is in orange, and the diluted is in blue, there is a difference over here. Let's understand this. See, first and the foremost thing, let's leave this graph here and understand what are the outstanding shares. See, outstanding shares are the shares that are being owned by the stockholders, company officials, and the investors in the public domain. It includes all the retail investors also, and also the institutional investors and insiders. However, the stocks outstanding does not include any sort of the treasury stock. It does not. So a company always often keeps a portion of its outstanding shares of the stock in its own treasury from both the initial stock issue as well as the stock repurchase, which are also known as treasury shares, and they are not included in the outstanding balance. And increasingly, the treasury shares will always result in decrease in the outstanding shares, and vice versa the case. So let's understand the outstanding shares versus the authorized shares in detailed format. Outstanding shares basically and authorized shares AS. Now, outstanding shares basically it differs from the authorized shares. As you know, the authorized shares are the number of shares that a corporate legally is allowed to issue, whereas the outstanding shares, this is authorized over here. The outstanding stock, the outstanding shares, outstanding stocks are the one that have been already that has been issued. So this is the key difference in the market. Now, at any given point of time, the outstanding number of stock cannot be, it has to be less than the number of authorized shares. Generally, the company authorizes more shares than the actual issuance size. Key reason for its efficiency and practicality. If the company issues all the authorized shares, but then need to grant more shares in future, the company would need to authorize more shares at that point of time. This requires the board and the stockholders vote and then a document to be filed. This cost money, the legal fees and filing that are involved in. Now, if the company has excess authorized shares, it can issue those with much less effort. Typically, just approval of the board of directors goes really very handy. Now, let's understand the outstanding shares formula. See, the outstanding shares formula goes something like this. Outstanding shares is equal to your issued stock less the treasury stock. This is going to be the difference. So this is the formula. The number of the stocks outstanding is equal to the number of the issued shares minus the shares held in the company's treasury. So it is also equal to the float. You can say that float means the shares that are available to public and excluding any restricted shares or the shares held by the company officers or insider plus any restricted shares. Like for example, if a company issues, let's say, a total of 1000 shares and 600 shares are issued as, let's say, floating shares to the general public and 200 are kept at the company's treasury. In this case, the company has total how much? 800. The company has in total 800 shares, right, outstanding, and 200 as the treasury. Now, there are two type of shares outstanding. The one is called the basic. Now we are getting closer to that what we call as the graph that we saw in the very beginning. The basic shares outstanding, and the second that we have is the fully diluted shares outstanding. Basic shares outstanding means that the number of the outstanding stocks currently that outstanding, while the fully diluted shares number takes into account the things such as warrants, capital notes, and convertible stock. So in other words, the fully diluted number of shares outstanding tells you how many outstanding shares there could be potentially be. Warrants are basically, they are the instrument that gives the holder right to purchase more outstanding shares of the stock from the company's treasury. Now, whenever warrants are activated, stock outstanding increases while the number of the treasury stock increases. Like for example, let's say suppose there's a company called XYZ and it issues, let's say, 100 warrant. If all the warrants are activated, then XYZ will have to sell in total 100 shares from its treasury. Now, do you know why the shares outstanding keeps on changing? Why it keeps on changing? The shares outstanding I'm talking about here. See, outstanding shares will increase when the company increases the share capital by selling the new stock in public. This can be the first thing. Or when it declares a stock split. When it declares the stock split, in that scenario also it can happen. Conversely, the stock outstanding can decrease if a firm can say that completes a share buyback. I mean, that's called repurchase of its own shares by the company, which decreases the number of the outstanding stock in the public, and it increases the treasury shares amount. And there is another thing that is called as the reverse stock split, which means, that is the consolidation of the corporation shares according to the predetermined ratio. Now, how this shares outstanding they affect the investor? How do they affect the investors? See, a greater number of shares outstanding means that more stable company and the greater price stability, as it takes many more shares traded to create significant movement in the stock. Contrary to this, the outstanding shares of the stock with much lower number of shares outstanding, then in that scenario it should be more vulnerable to the price manipulations and requires much fewer shares to be traded up or down to move the stock price. Now, as the number of these stock prices are important value for any investor, as it is included in the latest market cap, is included in the latest market cap, and the EPS, that is the earning per share calculation, it is really very important to be understood. And in that scenario, let's understand an example. Let's say there's a company here which has issued 25,800 shares, and it has offered, let's say, 2,000 shares to two partners and has retained, let's say, 5,500 stocks in the treasury. So the outstanding shares formula is the shares issue minus the treasury shares. So it's going to be 25,800 minus 5,500 less you'll need to deduct, that is 2 into 2000. So once you deduct this shares from here, you get 16,300. That's the outstanding shares formula. Now suppose this stock is, let's say, currently trading at 35.65. Therefore the market cap of the firm is going to be 16,300 into the share price. So that's going to be $581,095. Now company A, let's say it has a net income of 12,500 as per the latest financial, and therefore the firm's earning per share is going to be 12,500 divided by the number of shares, that is 16,300. So that's gonna be 0.77, right? So this is the example that you should understand. See, as the number of the outstanding shares of the stock decreases by 1,000, the company's EPS over here will also decrease closely by 6.4% with these numbers outstanding. And also the stock outstanding is important parameter used in calculation of the PB ratio, which is the indicator of how much the shareholders are paying for the net assets of the company. So that's it for this particular topic of outstanding shares. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.